Welcome to the 2025 Economic Depression and Preparation Channel. I'm your host, Tony. Thank you for joining me on this Wednesday, Hump Day, January 29, 2025. It's hard to believe that January is almost over, this first month of the new year here. But here we are, and stocks begin to slip today. The Dow Jones and NASDAQ down today as the FOMC pauses on rate cuts. So as you know, last year we had about 4 or 5 rate cuts. Now we're in a pausing here, as many economists had expected that there would be another quarter point 25 basis rate cut. We did not get that today on Wednesday, as Fed Chair Jerome Powell made the announcement that he pauses on the rate cuts. It's been a decision of the board to pause. So S&P 500 index was down negative 0.28 percentage points. The Dow Jones was up 0.6, and the NASDAQ was down 0.33 percentage points here. So stocks are under pressure today, as the Federal Open Market Committee meeting, the FOMC meeting that they had today, Tuesday and Wednesday, they left rates unchanged at 4.25% to 4.5% as expected. But they noted that inflation remains somewhat elevated. So inflation's elevated, and also what's elevated is these jobs. This either underemployment or unemployment is starting to tick up just ever so slightly. And you remember, as we head out of the fourth quarter into this first quarter of 2025, they also have earnings reports to think about now, as Microsoft and other companies, Nvidia, Meta, Tesla, are going to be reporting first quarter earnings sometime next week or next month here as we get into February. And so all of this is very concerning now for investors here. It's not surprising, but it is something that's concerning. And I told you before that they could very well leave rates unchanged. I thought they would leave rates unchanged in December, but that didn't happen. Now we get the rate unchanged in January here as expected. So gold prices, according to Kitco News, drops as Federal Reserve leaves rates unchanged. So now gold prices go back down. They were hovering around $27.50 an ounce. And now they've gone down a little bit here. Silver still above $30 an ounce, of course. So, but not too much changes there. But the thing is that with this putting pressure on the markets here, one thing to look out for is whether the dollar loses strength relatively around the world, and in terms of the other baskets of currencies as we go later into the first quarter. As you know, the dollar is very strong right now and against a lot of currencies, but we'll see what happens as time goes on. Bank of Canada, according to CNBC.com, they cut rates. So Bank of Canada decided to buck the trend here. They went ahead and cut their rates. Says tariffs could, quote, stoke persistent inflation. So everybody's worried about the tariffs that our current administration and our current President Trump may impose on such places like China and other countries in South America. How would that affect our production? How would that affect the prices here? Not just egg prices. Egg prices have been tremendously high because according to the media, they claim it's bird flu. But we know that, we've had prices high on a lot of other things besides eggs that were not related to any type of pandemic activity, so to speak. But in any event, Bank of Canada, they trimmed its policy rate by 25 basis points to 3%. They cut growth forecasts and say that it's concerned that, quote, U.S. tariffs could stoke persistently high inflation. So everybody's worried about inflation, but at the same time, we've got to get spending under control. And this goes for all first world countries and all G20 countries that are a member around the world. And so spending, the name of the game is getting spending under control. The Canadian Central Bank recognizes that, and they're beginning to cut these rates and let some more breathing room, try to allow breathing room in this economy here. But at the same time, this could be a double-edged sword for them, because if inflation goes up and they're cutting rates, they may not have any room to cut back once things get back to normal. U.S. home sales in 2024 fell to its lowest level since 1995. As you know, home sales have slowed down, sparked in part by mortgage rates up by 7% at best. Really, it's closer to 8%. For a lot of these new home conditions here. So despite tough conditions for buyers, there's some momentum toward the end of 2024, with existing home sales rising 2.2% in December from the prior months, according to Getty Images here. You can see, and looks like this is in South Florida here. So we've had home sales on existing homes come up, but new starter homes and, luxury homes and higher end homes and second and third rental homes, all of that's down since the lowest level since 95 here. And obviously, because two reasons: people have less disposable income with all these other things that have skyrocketed, like homeowners insurance, taxes, you name it, car payments because of the interest rates. So less disposable income translates to less people buying, wanting to lock down into these longer home deals where you can just rent something and be more flexible, even though, you're not building equity. But some people don't need that if they're older, or if they're retired, if they're, if their job takes them places around the world. They don't necessarily need a permanent home, quote unquote. And so that's something to look out to for as well, where the housing market may go. Because in the beginning, you remember a lot of financial pundits were telling you that, oh yeah, the prices have to drop because right now the interest rates are going up, so prices have to come down. And that's what we kind of had going on in the 80s, in the late 80s, when before we had the savings and loan crisis, where, it was not uncommon to get a house for what? You had a 16% interest rate, 15% interest rate, but houses back then were much cheaper. It was only like 100,000, 120,000, if that. So, that's the conundrum that we have here, some 40 or 50 years odd years later here in America. So we just have to wait and see what happens with that. But once again, the earnings report, Tesla and Microsoft earnings are incoming, so we're going to be looking forward to that. The Treasury yields are up. The 10-year and the 2-year Treasury yields are up, and so that's something to be looking at that as well. But the earnings reports are going to be basically coming out of the big tech companies here. And basically, if they go down, then obviously, the stock market's going to be more tepid. There won't be much growth going into February. But if the reports come out good, then obviously you're going to see another surge, of Wall Street and Dow Jones a little bit before the next bad news arrives, most likely having to do with the housing market again, and new home starts and new building starts and manufacturing. That's to look forward to in the next month here in February as we go to February. So continue to prepare, continue to stay aware, continue to stay prayed up, in all cases, because anything can happen, not just financial, but spiritually, socially, and mentally. All of us have to work together to make sure that we are in our best, using everything that, all the tools that God has given us to be able to survive, not only survive, but to thrive in wherever country you may be in. So God bless you. I'll talk to you very soon. Thank you for listening, and I'll see you on the next episode.